Welcome back, students. Today we are starting with chapter number 16, partnerships. These are the objectives of the chapter. You can pause and take a quick look. We will be covering all this in this video. Okay, moving on to sole trader versus partnership businesses. We have discussed a sole trader business in detail in chapter number 15. It's a single owner running and managing the entire business. Now we are talking about partnerships. More owners, okay? They can be between 2 to 20 partners in a partnership business. If there are more than 20 owners, we usually call that a company business, which we will discuss in the coming chapters. For now, let's focus on partnership businesses. In O level accounting, all the questions that you get are relating to two partners only. So you don't have to worry about more than two partners in any question. So we will also discuss keeping in mind two partners. Okay. Now start thinking what can be the advantages and what can be the disadvantages of having more than one owner. See, let's suppose you had a business, you had a bakery. Okay, you had a bakery and you were the single owner. Now you want to start a partnership with your friend. Think of any friend you like, and now you want to start a bakery in a partnership business with a friend. It can be the same bakery. You can decide that okay, my bakery is doing well. Let me introduce my friend as well and form a partnership, and we can both own the business and run and manage the business together. Okay. So now think of the advantages and disadvantages that you're going to have when you decide to form a partnership. Okay, let's discuss those. See, let's first talk about the partnership businesses that can be formed. Okay, a partnership business can be a trading business that buys and sells goods. It can also be a service providing business, and it can be a combination of both. It can also be a manufacturing concern, those businesses that manufacture their own goods and then they sell it in the market. Okay, now moving on to the advantages of forming a partnership. See, partnerships are also very easy and cheap to set up. There's not a lot of paperwork. You can just go talk to your friend and start a partnership business. Obviously, there will be some paperwork involved, which we will talk about in the coming slides. Now, the biggest advantage is more capital. You will have more money, right? Because when you are the single owner, you have a limited amount of capital that you can invest into the business. Let's say you had $10,000 and you invested those 10,000 into your business. Now, when you have more than one owner, you can have more money. Maybe your partner can bring in $10,000 more. So now the total capital that the business will have is $20,000. So you can expand the business, you can buy more machinery, you can hire better staff. Okay? So that's why more capital is always useful. The next advantage is different skill set. Maybe you as the owner were really good at making your products. Like you were very good, you knew how to develop the products and what the quality should be and all that. But the partner that you have now is very good at marketing. So you have different skill sets which can help your business grow, right? You were not good at marketing, but your friend who is your partner now is good at marketing, so you can benefit from that different skill set. Okay, next, partnership can provide for more creative ideas that contribute to good decisions. Okay, again taking the example of bakery. Let's suppose you were the single owner. You were selling the regular stuff, which is cakes, biscuits, bread, etc. But when your partner came into your business, he or she gave you a lot of creative ideas. They told you that you can also start selling coffee. You can also start selling hot soup in winters, and you can also set up a salad bar. So see, more creative ideas you can get from your partners, and that can contribute to good decisions. This is what they mean by that. Now, next is that responsibilities and risks are shared. When you were the single owner, everything was on your head. Okay, you have to manage the staff, you have to look after the production, you have to look after the marketing. You obviously you had employees to help you, but employees will not give you their 100%. Okay, even if they're really good. But if it's your own business, you will invest more time and you will think about it responsibly. So if you have more partners, they can help you with a lot of things. They can take responsibilities, and also the risks are shared. Okay, if your business, which is linked to the next point, if you have losses in your business, they are also shared with your partners. So it's a good thing. Even though you will not aim to have losses, you want to be profitable, but at least you are covered in a way. Okay. Disadvantages of forming a partnership: the biggest disadvantage is that you now have to share your profits with your partners, right? Then secondly, there can be disagreements. Okay, you might think that setting up a salad bar is not a good idea, but your partner is insisting. He or she is telling you that we must set up a salad bar. So there can be disagreements, right? It might be a good idea, it might be a bad idea. Okay, and similarly, this point is also linked. As decisions are jointly made, they take longer. You will have to think for a bit longer. Whereas when you were the single owner, it's in your hand. You wanted to set up a salad bar, you can set it up right away. Now you have to wait for all the partners, okay, to decide that do you want to set up a salad bar, and then decision making will take longer, right? Okay. All partners are liable for the errors made. Yes. Even if one partner makes any error, you will all have to bear the consequences of that error. And then unlimited liability, which is similar to sole trader. In a partnership business, you still have unlimited liability. I've discussed in detail what this is. This simply means that if your business fails, you sell off all your assets to pay off the loans, but then still there are some leftover loans. You will have to sell your personal property, your personal car, to pay off those loans. So that's a disadvantage of a partnership business, which is not there usually in company businesses, which we will cover later. Okay, moving on. Importance of a partnership agreement. Okay, see, whenever you will form a partnership with someone, you will have to make a partnership agreement, because even though things look very good at the beginning, okay, you're forming a partnership with your friend and he's your very close friend, okay, you might be thinking that why do we need an agreement? Okay, we are good friends, we can manage. No, there can be times later on in the business when you can have conflicts, okay. So to avoid any such thing, you usually form a legal document known as a partnership agreement. Okay, now I will tell you what things are included in that. Let's move forward. All right, let's discuss quickly the important contents of a partnership agreement. Things that you should include in the partnership agreement. First of all, percentage of ownership. Let's say you have two partners, partner A and partner B. Partner A and partner B can have a different percentage of ownership. It is not necessary that it is always 50-50. Okay? No, it is not necessary. It can be 70% and 30%. Okay? It depends mainly on the initial investment of the partners. Okay? Let's suppose A has invested $70,000 into the business when the business is being formed, and B has invested only $30,000. So according to that, they have also decided the ownership in the business, which is 70% and 30%, which is fair, right? So percentage of ownership can be different. Similarly, distribution of profit and losses can also be different. If this is the case, you might think that profit and losses should also be shared in the same ratio, which is 70% of the profit should go to A and 30% of the profit should go to B. Okay? This should happen obviously, but there are some special conditions. ठीक है, it is also possible that A and B decide that the profits will be shared 50-50 regardless of the initial investment. What can be the reason of that? There are several reasons. It might be that B is very, very skilled and has a lot of experience of running such type of business. So B will say to A that even though you are investing more money than me, I will still take 50% of the profit because I have a lot more experience than you. So he has a skill. ठीक है? So they can decide, okay, we will share the profits 50-50 and losses 50-50. Even if you have invested less than me, you're more skilled than me. So you can take 50% of the profit. Okay? So there can be reasons like these. But all these things should be decided at the time of partnership agreement, not later. Okay. Partners drawings limits. Okay. You know what drawings are. Drawings is when the owner of the business takes money from the business home for personal use. Okay. When you were a sole trader, a single owner, there was no one to question you. You can take as much money home from the business in the form of drawings. You're not answerable to anyone. But now, when you have partners, you are answerable. You cannot take home all the money from the business without consulting with your partners or without having to answer them, right? So now we usually set up drawing limits. We can set a limit K. Every partner can withdraw maximum $5,000 in the form of drawings per year, not more than that. Why do we keep a limit? Because if we don't keep a limit, it might be harmful for the business. Any partner might withdraw any amount of money and then the business will be short of money. When the money is needed, you will not have that. So you have to set a limit. Okay? Interest on partners' capital. First of all, we know what capital is. Capital is the investment of the owners in the business, the money they have invested into the business. Let's take a simple example to understand this point of interest on partners' capital. Okay? Let's suppose we have partner A and partner B. Partner A has invested $10,000 into the business, and partner B has also invested $10,000 into the business. Alright, so it's fair, both have invested the same amount and they are running the business, they are sharing profits in the ratio 50-50. So all is good. Okay? Now, let's suppose from somewhere partner A got extra cash which he can invest in the business now. Let's say he got $5,000 more from somewhere which is extra, and he can invest that money into the business in the form of capital. Okay? But there will be a thought in partner A's mind that why should I invest this money in the business? I will still get 50% of the profits because it's written in the partnership agreement unless you change it. Okay? And partner B is also getting 50% of the profit. We have the same investment, so why should I invest 5,000 more? Even if the business will grow, but partner B will also get the same benefit out of that. So instead of putting the money in my business, let me just go and deposit this 5,000 in my bank account. And then I can simply earn interest on that, because when you keep money in your bank account, the bank will give you an interest, right? I can earn interest, and that's my personal money. I'm still running the business with partner B. We have the same investment, so it's fine. See, but now we want to encourage partners to not invest or put money in the bank account. We want them to invest this money, any extra money that they have, back into the business. How can we encourage them? By providing an interest on capital. Okay, we will form an agreement. We will tell them that if you invest more money into the business, okay, you can charge interest on that from the business, similar to what you were getting from the bank. So then partner A will think, okay, now it's fine. Now I can invest this money into my business and I'm also getting the interest. So I am having a better deal now. I'm getting interest first of all, which I was about to get from the bank as well. So I'm still getting that interest, and I'm also helping my business grow. So now the partner will decide to invest back into the business instead of giving money or putting money into the bank account. Okay, so this is why interest on partners capital is important, to encourage partners to invest more money into the business. Now, interest on partners loan. Okay, if a partner gives a loan to the business, ठीक है, it might be that you don't want to take a loan from the bank, and partner A has extra money. Okay, but he or she doesn't want to invest more in the business because they think it's risky, but they're ready to provide a loan to the business. So we will take the loan from partner A and simply give them an interest on the loan. When you take a loan from the bank, you have to pay an interest, so we will also pay partners an interest to keep it fair. Okay, so if you take a loan from the partner for the business, you will also give interest back to the partner. That's it, simple point. Okay, moving on to interest on drawings. We know what drawings are. Drawings is when the partners withdraw money from the business for personal use. Okay, let's suppose partner A has withdrawn $2,000 from the business, whereas partner B has withdrawn nothing from the business. So partner B might think that this is unfair. Why is partner A taking home money? Then he will think that I should also take $2,000 home. It will affect the business then. Okay, so to discourage drawings, we have kept an interest on drawings. ठीक है, when you were a single owner, you did not worry about all this. It's your call, you can take as much money home from the business. ठीक है, you're the single owner, your business will suffer, you don't have to answer anyone. But now you have partners, you have to answer them. So if you're taking home money, you have to pay interest on that as well, just like you pay an interest on bank loans. ठीक है, to keep it fair for all the partners. ठीक है, now the last point, partners salaries. Okay, some partners might be working more than the others. Let's say A is giving only 2 hours every day to the business, whereas B is working for 6 hours. ठीक है, you did not want to distribute more profit to B, it was still 50-50. ठीक है, to keep it simple, or whatever reason was to keep the profits at 50-50. So now you have to compensate B in some way. How will you compensate partner B for the extra effort? You will simply provide a salary, a fixed salary to partner B, depending on how much more work he's doing than partner A. ठीक है, so simple. Now moving on to the next slide, profit and loss appropriation account. Okay, now listen. In a sole trader business, we had two financial statements. ठीक है, the first one was income statement, in which we were calculating the profit or loss made by the business, and the second one was statement of financial position, which is simply a list of all your assets, liabilities and capital. ठीक है, now in a partnership business, you will have to prepare a few extra statements. ठीक है, the income statement will still be prepared, which will be used to calculate the profit made by the business. After the income statement, you will have to prepare a profit and loss appropriation account. Profit and loss appropriation account. And then you will still prepare statement of financial position. So As you can see, there's one extra statement included in a partnership business: profit and loss appropriation account, which is prepared after preparing the income statement. I will also tell you the reason why it is prepared after the income statement. See, as you can understand from what is written here, profit and loss appropriation. Appropriation means to divide. So we have to prepare a statement in which we will divide the profit between the two partners. Okay, it is a statement, it's a fixed format. I will show you the format in the next slide. So you have to divide the profit between the partners using that account, which is called the profit and loss appropriation account, and that's the purpose of this account. The purpose is to divide the profit or loss made by the business between the partners. Okay, simple. What is this appropriation account used for? It is used to divide the profit or loss made by the business between the partners. Moving on to the format. I think, okay, let me prepare the format here myself. See, one second. See, we have a few things in a partnership agreement. ठीक है? Let me write those things again. We have interest on drawings. We have interest on capital, and then we also have partners salaries. Okay, these three things. As you know, in income statement we are only talking about incomes and expenses. All right, where does the income statement end? Do you remember? What do we find in the end? We do everything. We start with sales, we minus cost of sales, from that we get gross profit. Okay, then we add other income, we subtract all the expenses. What do we get in the end? We get the profit for the year. Let me write it here: profit for the year. Let's say it was $100,000. All right. So this is where the income statement ends. The appropriation account starts from where the income statement ends, because what do we have to do in the appropriation account? We have to divide this profit between the partners, but we also have to include these three things, include or exclude these three things from the profit first. Okay, because where will we adjust these things? These are the new things that are part of a partnership agreement. Okay, in sole trader we prepare the income statement till profit for the year, and that's it. Okay, that's the profit the business has made, and it goes to the single owner that there is in the business. In a partnership business we have these extra things as well. These are also incomes or expenses of the business. Okay, now please read these one by one and think which one out of these is an income for the business. Income means that due to that thing the profit should go up. So look at these three things and think, okay, out of these three things, which of these will increase the profit made by the business, and expenses are those things which will decrease the profit made by the business. Right? Expenses kya hote hain? Expenses are those things that decrease the profit made by the business, and incomes are those things that will increase the profit made by the. So out of these three, what do you think? Which one will increase the profit and which one will decrease the profit the business has made? Think for a moment, then I will tell you. Let me erase this, because I will have to make the format here. Okay, let's talk about the first thing: interest on drawings. Interest on drawings. You have to look at these things from the point of view of the business, not the partners. Okay. So interest on drawings are paid by the partners to the business, right? Right or wrong? Why is it paid by the partners to the business? Because when the partners withdraw a specific amount of money from the business, they have to pay an interest back to the business. Okay? So this amount is paid by the partners to the business. So usually interest on drawings will be added to the profit for the year. So the format will start with add interest on drawings. ठीक है. Let's suppose partner A is supposed to pay $400 interest on drawings and partner B is supposed to pay $600 interest on drawings. So combined it is $1,000. So now the business will be having $101,000 in total, right? Because this is the profit the business has made, and now furthermore it is charging an interest on drawings from the partners, which is 400 from partner A and 600 from partner B. So the business is getting $1,000 more from the partners. So now the total profit made by the business is $101,000. Let's look at the next thing. Interest on capital. What is interest on capital? Is it paid? Start thinking. Is it paid by the partners to the business or by the business to the partners? Please think till I'm writing this. Interest on capital. What is interest on capital? Interest on capital is paid by the business to the partners, all right, for investing money into the business. So it is paid by the business to the partners. So that's why we have to subtract this from the profit of the business, because it is an expense for the business in a way. So we will write less interest on capital, and then partner A and partner B. Let's say we are paying $1,000 to partner A for the amount they have invested and $2,000 for partner B. This is less, which means it will be subtracted out of the total profit. So we will subtract 3,000 out of this. We will be left over with $98,000. Okay. Now, moving on to salaries. Salaries are paid to those partners that are giving more time to the business. I've told you that. Okay? There can also be other reasons for giving salaries to partners, but the main reason is that they are giving more time. So are salaries paid by the partners to the business, or is the business paying the salary to the partner? It is paid by the business to the partners. Okay. So again we will write less salaries, and usually salaries are only paid to one of the partners, so we can just write salaries of A, and then let's suppose that we are paying $8,000 to A as salary. So now the business will be left over with just $90,000. Okay. So remember this. These are the three things that we have to include in profit and loss appropriation account. This new amount is the profit that will be shared between the partners. We will call this profit to be shared. Okay. Even though the business made 100,000 in profit during the year, we also have to adjust these three things now, which are part of the partnership agreement. From where will you pay the salaries to the partners? From the profit the business has made, right? From where will you pay interest on the capital they are investing? From the profit the business has made. ठीक है. And where will you include the interest you are getting from the partners on the money they are withdrawing into the profit? ठीक है. So remember that. So this is the final profit that will be shared between the partners, and then whatever percentage is decided, it will be shared in that ratio to the partners. This is not the complete format. We also have to share the profit between the partners under this. I will show you that in the coming example. But this is the basic idea of how you form this profit and loss appropriation account. You have to adjust these three things: interest on drawings, interest on capital, and salaries. Okay, let's erase this and move on to the example. Alright, let's begin with the example. Now see, I have told you that they will only test you or give you questions relating to two partners, and as you can see, they're talking about two partners in this. Okay? Mary and Jane are in a partnership and share profit and losses in the ratio 1:3. I hope you know how to convert ratio to percentage. The total parts are 1 plus 3, 4 parts. Okay, 1 plus 3. Mary's share is one part out of the 4 parts, as you can see. So Mary's share is 1 upon 4, whereas Jane's share is 3 upon 4. So don't worry, if you get it in ratios, it is very easy to quickly convert this into percentages as well. Now you simply multiply this by 100, you will get Mary's profit share as 25% and Jane's profit share will be 75%. You can use your calculators and double check. This is how you will find the the share of profit and losses in percentage if it is given in ratio form. Okay, they can give you this share. Usually they will give you in ratio form, so you should know how to convert. Okay, basic math. Now let me erase this, but I will have to keep it somewhere so that I don't have to recalculate this. I can simply make a portion here for rough work. So Mary 25%. This is my rough work, so I can write it as I like. And Jane 75%. Okay. Now let's read further. Mary has contributed a capital of 4,000 and Jane 3,500. Okay. So the capital that they have invested is 4,000 for Mary and 3,500 for Jane. Okay. On which they are entitled to an interest of 10% per annum. So what is the interest on capital? It is 10% per year. So I can easily find interest on capital. How? By multiplying these amounts by 10%. Multiply by 10%. Okay. We will get interest on capital. So this is how we take out interest on capital from the question. It is very easy. The capital will be given, the interest on capital, the percentage is also given. So you simply have to use your calculator. 4,000 multiplied by 10, and you can shift and click the percentage sign to simply find it directly. Okay, and then this will be 350. If you don't know how to click the percentage sign, you can do this. 4,000 multiplied by 10%, which means 4,000 multiplied by 10 upon 100, and then use your calculator and get the answer. Okay. Now let me erase this as I need this space. So we have interest on capital as well now by reading this question. So see, as I am reading, I am using that data and keeping things here with me so that I can use these things in the appropriation account. I know what do I need for the appropriation account. I need interest on capital, I need interest on drawings, I need salaries of the partners, and I need this ratio in which the profits will be shared in the end. That's it. I need these 4 things basically. So I am writing these things here. Now, Mary's drawings for the year are 2000. Okay, now they are telling me things relating to drawings, so I will write it here. I will give the heading of drawings. I will write Mary, M for Mary. So this is my rough work. I can write M 2000, and then Jane's drawings were 3000. Okay, where is it written in the question? Here, let me highlight this. 2000 Mary's drawings, and Jane's drawings are 3000. Okay, so I'm just copying the data from the question. I'm not finding anything on my own. Okay, everything is mentioned in the question. They are to be charged an interest of 5% on drawings. Okay, so simply multiply the drawings with 5%. You will get the interest on drawings. Simple. So this will be interest on drawings. Use your calculators again, just like I told you. 2000 multiplied by 5 upon 100, you will get the interest on drawings. So for Mary it is $100. Let's write it here. And then for Jane it is $150. So we have figured out the interest on capital. We have also figured out the interest on drawings. The two things that we need. Now we need salaries. So let's read further. Okay, is to be charged an interest of 5% on drawings. We are done till that. Jane is to have a salary of $500 per annum. Per annum means per year. So they've also told us about the salary. Only Jane is getting the salary, and it is $500. Okay. The profit for the year before appropriation is 7,000. Right. They have also given us the profit, because in these questions basically they will not ask you to prepare the entire income statement. Okay, because they're testing you on new topics, on partnership related topics. Income statement you have already done in sole trader. If they wanted to test you on income statement, they will give you a sole trader question. In this they want to know, are you able to prepare the appropriation account or not? So they have given you the profit. You don't have to make the income statement to find the profit. Profit is given in the question. So the profit before appropriation is $7,000. Before appropriation means before dividing it between the partners, before doing any of these workings. Okay, these three things that we need: interest on capital, interest on drawings, and salaries. Now the balances on their current accounts are Mary 40 and Jane 600. You don't have to worry about this for now. This will be discussed later. This is not part of the appropriation account. Current accounts are usually part of statement of financial position. So ignore this for now. Okay, let's start preparing the appropriation account. Now, the appropriation account starts where the income statement ends, which is the profit for the year. Okay, you will give the heading here, profit and loss appropriation account. I'm not giving the heading, I don't have that much space here. So I'm just starting with, okay, make two columns. One is the working column and one is the totals column, as always. Profit for the year. Or one second, let me move this to open board and do it there. Okay, I am copying all this and moving this to open board so that I have enough space to do the entire working without having to skip things. This is my data, and I will prepare the appropriation account on this fresh page. So let's begin. First of all, I will give the heading profit and loss appropriation account. So in your CIEs, they usually give you the format in which the heading is already placed on top of the blank space. So you don't have to write this maybe. Profit and loss appropriation account. That's the name of this statement. Okay, it is a separate statement after your income statement. So don't get confused. But this starts where the income statement ends. The income statement ends at profit for the year, and this statement begins with that. So we will use two columns, for one for your working and one for totals as always. So let's write the profit for the year. This profit will always be given in the question unless they ask you to make the income statement before the appropriation account, which is usually not the case. Okay, so profit for, now I have all the information here in rough, okay, here. So I can use this to make the appropriation account. I will start with the profit for the year, which is $7,000. I can directly write this in the second column as there is no need for working here. Then what do we add to this? We add interest on drawings. This is the part of the format as explained to you in the earlier slide. Now try to remember this, okay? Keep this in mind. The first thing you have to do is add interest on drawings to the profit for the year. So Mary, the first partner, and then Jane, the second partner. Okay, let's pick the data from the rough work. Interest on drawing for Mary was 100 and for Jane was 150. So I can simply write it here, 100 and 150. Why are we adding this to the profit? Because this interest this interest is paid by the partners to the business, right? So $250 is given to the business by the partners. So now the amount that we have available is 7250. That's the new profit in a way of the business, right? Because this is the income that the business has generated from the partners. The partners are giving this money to the business. Now we have to deduct the interest on capital from this amount. What is interest on capital? Interest on capital is the money that the business pays to the partners for investing money into the business. Okay? This is usually done to encourage partners to invest more into the business. So Mary and Jane, we have done the calculations already, so we can pick the data here. Interest on capital of Mary is 400 and Jane is 350. So 400 plus 350, total becomes 750. Let me double check. Always double check, okay? Don't make these mistakes because they will cost you a lot. You will not lose just 1 mark here. Your entire statement will be wrong. So it's better to double check, okay? You will have time. Now let's subtract this from the new profit. Why are we subtracting this? Because this interest on capital is paid by the business to the partners, as we have discussed previously. This is to encourage the partners to invest more money into the business. 7250 minus 750 gives me 6500. Okay, moving on. The next thing you have to do is deduct salaries from it. So less salary. We usually give salary to only one partner, and in this case salary was given only to Jane, which was $500. So we don't have to use the working column. We can simply write salary of Jane and then we can deduct 500 from here directly. So the new amount will become 6,000. This is the final amount. We will call this the profit to be shared. Profit to be shared. Okay, simple. See, what did we do? We have simply used the profit for the year given in the question. We have added interest on drawings to that. We have subtracted interest on capitals from that, and we have also subtracted salary of Jane from that. Okay? So we have only 3 things. We always add interest on drawings, we subtract interest on capitals and salaries from the amount. Now we have the profit to be shared, which is $6,000. Now we have to divide this profit between the partners. So you will write share of profits ठीक है. This is the subheading, and then Mary and Jane. All right. So Mary should get how much out of this 6,000? Mary's share is 25%, as you can see, and Jane's share is 75%. So Mary will get 25% of 6,000 and Jane will get 75% of the 6,000. Let's calculate 6,000 into 25. It's 1,500 for Mary, and then 6,000 into 75%. It's 4,500 for Jane. This is their share of profits. ठीक है. The total will obviously be 6,000 because that was the total amount which was shared between the two partners. But this is the individual share of profits of the partners. Mary will get 1,500 out of the 6,000 because her share is only 25% as given in the question. As you can see, let me zoom this. ठीक है. We have calculated that it was 1/4, which makes up 25% of the profit share, and we had written it here. ठीक है. And Jane is getting 75% of the profit, so her share is $4,500. Let me zoom this out and show you the complete appropriation account in one go. See, this is the appropriation account. It is not difficult. You have to start with profit for the year. You have to add interest on drawings of the partner, which you find from the question. You have to less interest on capital, which you also find from the question. Salaries are also given. And then you just divide the profit between the partners in the ratio that is given in the question. That's it. This is the profit and loss appropriation account. The purpose is to divide the profit between the partners, and we have done that. 1,500 belongs to Mary and 4,500 belongs to Jane. Now, things to remember. In some questions, there might be interest on drawings missing, so ignore that. There might be interest on capital missing, ignore that. There might be salaries missing, ignore that. Okay. So whatever is given in the question, you only have to focus on that, and things that are not given, you just ignore that. For example, in this question, there was no salary of Jane. Okay, for example, then you just ignore this altogether. Then the profit to be shared will be 6,000 instead of, then the profit to be shared will be 6,500 instead of 6,000, as no salary is paid. Okay. And then you can simply do this. 6,500 into 25% and then 6,500 into 75% and get the new shares. So you don't have to worry about things that are not given. In some businesses, salaries might not be given. So just ignore that and complete the format. Okay. So we have completed this. Now moving on to the capital and current accounts. See, in sole trader businesses, when we were making the statement of financial position, you might be remembering that, one second, that in the capital section of the SOFP, we had only three things. First of all, we had the capital, which was given in the question. Okay, this was the investment of the owner in the business. Then we were deducting the drawings out of it, the money that they withdrew out of the business, and then we were simply adding profit to it, and then we got the closing capital. This was the format of the SOFP capital section of a sole trader. Now in a partnership business, the SOFP will be same or similar. The non-current asset section will be exactly the same. The current asset section will be the same. Non-current liabilities, current liabilities, almost same. But the capital section will be a lot different than that of a sole trader. Why? Because now we have multiple partners. In that sole trader, we had just one partner. We had just one owner. So the capital section was very easy and it was done in simply 3 steps. Now we have to worry about a few things. So the capital section is a bit different, and I have to explain you the differences in the capital section now. Okay, so first of all, we maintain 2 separate accounts for capital. Okay, one is known as the fixed capital account. Okay, let's say partner A invested $10,000 into the business when the business was formed. ए ने कितने इन्वेस्ट किए थे? $10,000 and B had invested $5,000. So this was their initial investment. These initial investments are recorded and kept in the fixed capital accounts. Okay, so this amount remains the same every year, right? Because this is the initial investment of the partners, which can never change now. This is the money they invested when the partnership was formed or when the business started. So this amount is never changing. That's why they are called fixed capital accounts. This is just a record of what they invested in the business when the business was formed. Simple. Okay, let's read this. Fixed capital amount is when the capital account of each partner remains at the figure of capital contributed by the partner. Simple. Okay, so very easy to understand. Now, what are current accounts? All right. Apart from the fixed capital account, we also need a current account. What's the purpose of the current account? See, in this business, we have a lot of things. We have share of profits, we have partner salaries, we have interest on capital, we have interest on drawings. Where will we maintain the data of all that? In the current account. Okay, the fixed capital account is only there to record the initial investment of the partners. The current account will keep the track of all the current activities of the partners, in simple words. Let me explain it further using the same example for which we prepared the appropriation account. So see, okay, let's use this example and make the current account for the partners. Okay, current account is simply a T account of capital. One second, let me move this to open board. Okay, let's just take this example to open board and make the current account over there. Let's open a fresh page, erase all this, zoom this out, move this here. Okay, now see, a current account is simply a T account of capital. Okay, you know what capital is? Capital is the investment of the owners in the business. So a current account is simply a T account. Okay, of capital. You should be knowing that capital, when it increases, we record it on the credit side, and capital when it decreases is recorded on the debit side. Okay. Now, you know the format of a T account: date, details, and then amount on the debit side, and similarly date, details, and amount on the credit side. If you don't know what T accounts are, please visit chapter number 3 first. Okay, so this is the format of a T account. We are simply preparing a T account of capital. ठीक है, current account क्या है? Current account is a T account of capital. But now, in these questions, we don't have just a single owner or a single person. We have two partners. So there will be a slight change. Okay, we can make a combined T account. Instead of making two separate T accounts, one for Mary and one for Jane, we can simply make a combined T account to save our time. We don't have to write the headings again and again. You can also make a separate T account, but it is preferred that you make a combined T account for both partners. So we can write, instead of the amounts column, we can write Mary, and then these will have Mary's amounts, and then Jane. This column will have amounts belonging to Jane. And similarly on the credit side, Mary and then Jane. Okay? So we are making a combined T account of both the partners. Let me keep a line here so that we don't get confused, to separate the amounts of both the partners. Okay, now the balances on their current accounts are 40 for Mary and 600 for Jane. Remember, I told you to ignore these when we were making the appropriation account, because these do not belong to the appropriation account. These are current account balances which we have to use over here. These will obviously come on the credit side because this is the balance that they have in their capital account, and capital account is always on the credit side because capital when increases is recorded on the credit side, as you know, and when capital decreases we record on the debit side. Dead click, chapter number 3. So balance carried down for Mary is 40 and Jane is 600. This is the money that the business owes to the partners. ठीक है? This is what the business owes to the partners, right? You know what is capital? Capital is the money that the business owes to the partners. The partners have to take this much money from the business. Mary's balance is 40, which means Mary is supposed to get $40 from the business, and Jane's balance is 600, which means Jane is supposed to get $600 from the business. It is in their account available. Now, things to include in current account. We have to include the following things. First of all, we have to include drawings, because you know drawings are always deducted from capital. ठीक है? Then we also have to include interest on drawings. Okay, we have to include interest on capital. We don't have to include the capital amount because it is in a separate capital or fixed capital account as discussed earlier, so only interest on capital. Then salaries if any, okay, and then profit share. If a partner has given a loan to the business, interest on loan will also be included. But in this question, there is no interest on partner's loan, so ignore that for now. Okay, now we have to think about including these 5 things into the current account, which is your capital account. So things that increase the capital of the partners, in simple words, the money that they have to receive from the business later, should be on the credit side. So those things are interest on capital, because interest on capital is the money that the business is giving to the partners for investing in the business, right? So the partners are gaining this from the business. Interest on capital, I think the working was available here. Yes. So interest on capital of Mary is 400. 1 second. 400. And for Jane, it was 350. Let me double check. Yeah, as you can see, 400 for Mary and 350 for Jane. So where am I picking this data from? From the appropriation account or from my rough work which we did earlier. Okay. Okay. Moving on to salaries. Again, salaries are given by the business to the partners, so it will increase their capital. That's why we will use the credit side. Jane was given a salary of 500. Let's check the appropriation account. Yeah, salary of Jane was 500. So we can simply write 500 in Jane's column. Mary did not get a salary, so you can just put a dash. Okay. Now profit share. Profit share again belongs to the partners, and the business is giving that in the form of money to the partners. So profit share increases the capital of the partners in the business, right? You remember, profit is always added to the capital, right? So profit share increases the capital of the partner. When capital increases, we record on the credit side. So let's look at the profit share. Mary's profit share was 1500 and Jane's profit share was 4500. Again, you can use the appropriation account to get this data. So 1500 for Mary and 4500 for Jane. Simple. Okay, let me double check. Yeah. Now, drawings. Okay, drawings reduce partner's capital. As you know, drawings are also subtracted from the capital of the partner. So capital is decreasing. When capital decreases, you have to record it on the debit side. What were the drawings? They are usually given in the question. Mary's drawings for the year were 2000, so 2000 in Mary's column, and Jane's drawings were 3000. So 3000 in Jane's column. Okay, we are done with interest. Sorry, we are done with drawings. We are done with interest on capital. We are done with salaries. We are done with profit share. Okay, interest on drawings is left. Again, interest on drawings is also paid by the partners to the business, or they are supposed to pay later, so it will decrease their capital. Interest on drawings is also recorded on the debit side, from where we you can quickly look at this from the appropriation account, because we have calculated that. So interest on drawings is 100 and 150, 100 for Mary and 150 for Jane. Okay, so this is it. This is how you prepare a current account. Okay. Drawings and interest on drawings are on the debit side, and everything else, which is interest on capital, salaries, and profit share, are on the credit side. So simple, keeping it simple, remember things that increase the partner's capital in the business are recorded on the credit side of the current account, and things that decrease the capital of the partners in the business are recorded on the debit side of the current account. Okay, because you know from debt click, capital when it increases is recorded on the credit side, and capital when it decreases is recorded on the debit side. Now let's balance this T account. Mary first. Okay, so we will compare the debit side column of Mary's account with the credit side column. As you can see, this is 2000 plus 100, 2100. I hope you know how to balance T accounts. Go through chapter 3 if you do not know that. So the total of the debit side is 2100, whereas the total of the credit side is 1940. You can add these three, they will be 1940. So as you can see, the heavier side is the debit side. So the total of the heavier side will come under both, and then you simply subtract this amount from 2100. So 2100 minus 1940 is giving me 160 as the balance carried down. And you know that balance brought down is always on the opposite side of the balance carried down. So her final balance, let's make this, or let me just copy these. One second. Never mind, just rewrite these. Date, details, ठीक है, Mary, Jane, and then date, details, Mary and Jane. Alright, so as you know, balance brought down is always on the opposite side of balance carried down. So the balance brought down for the next year for Mary is 160 on the debit side. Okay, this is a bad thing for Mary. Why? Because she has withdrawn more money than she has earned. As you can see, she has withdrawn 2000, and then she needs to pay an interest of $100 on that. So 2100 is the total amount she has to pay to the business. Okay? And on the other hand, this is what she earned during the year, which is 40 was her previous balance. Interest on capital, she should receive 400 for that. There was no salary, and profit share was 1500. So she was supposed to get 1940 from the business. And how much has she withdrawn? 2100. So she has a negative balance of 160. A debit balance in a capital account is a bad thing, because capital when it increases is on the credit side. So a debit balance is a negative balance in a capital account. So Mary is on negative 160. She owes this much to the business. She needs to pay this amount back to the business. Now let's balance it for Jane, and see, does she also have a negative balance or a positive balance? Let's see. Okay, Jane's total on the debit side is 3000 plus 150, so 3150, and her total on the credit side is 4500 plus 500 plus 350 plus 600, so 5950. ठीक है, total of the heavier side will come under both 5950 and 5950. This side is lighter, so we will subtract 3150 from 5950. We are getting 2800 on this side now. This will become balance carried down for Jane, and then balance brought down is always on the opposite side during the next period. So balance brought down for Jane is going to be 2800 on the credit side, which is a good thing. This is a positive balance. A credit balance in a capital account is a positive balance. So Jane is still in positive because she earned more than she withdraw. ठीक है? Her profit share was 4500. She also received a salary. She received interest on capital. Her balance was also good, and she has only withdrawn 3000 from the business, which is this, and she needs to pay 150 interest on that. So she is supposed to pay 3150 while she has earned 5950 from the business. So her balance is still positive, positive 2800. That's why it's a credit balance. So remember, a credit balance in the current account, this is the credit side, so Jane has a credit balance, as you can see. A credit balance is a good thing for the partner, it's a positive balance, whereas a debit balance such as this for Mary, this is a negative balance and it is not a good thing, okay, for the partner. This is the complete current account here in front of you in the form of a T account. Moving on to the slides. Okay, let's discuss the SOFP of a partnership business. As I have told you earlier, the non-current asset section is exactly same as sole trader, and I've covered that in detail in chapter number 15, so go through that if you still don't know. Then the current asset section is also same as sole trader. The non-current liability section is also same as sole trader, and then the current liability section is also same as sole trader. So I am not going into the details of that or explaining that again to you. I will only explain the capital section in this video because that one is not same as sole trader, it is different. Okay? Because now we have multiple partners, so the capital section cannot be the same, obviously. So let's look at the changes to the capital section. Okay? In the capital section, you can show it either like this or like this. Okay? What is the difference in these two ways? This is method 1 of making the SOFP capital section, and this is method 2. In method 1, we have simply put the final balance of the current account, as you can see. Okay? What are these capital account balances? Capital account balances, as we have discussed in the previous slides, let me show you, and this show. Okay, fixed capital account is when the capital account of each partner remains at the figure of the capital contributed by the partner. So this is a fixed amount of the initial investment of the partners. In the question we were told that Mary and Jane contributed 4,000 and 3,500. So that's the fixed capital amount, which is same in both the methods. Okay? Let me zoom this in. 4,000 for Mary, 3,500 for Jane. This is the capital they have invested in the business. This is also same in method 2, 4,000, 3,500, because this is a fixed amount that they invested in the business, 7,500, 7,500. The current account can either be shown inside the SOFP, or you can make a separate current account like we had in this. Let me show you on open board. This is a separate current account that we have prepared, and we have the final balances here. ठीक है, a debit balance in Mary's account and a credit balance in Jane's account. So if you have prepared a separate current account, you can simply use these two balances and put them in the SOFP, ठीक है, like they have done here. A debit balance is a negative balance, so it's in brackets for Mary, and then Jane's balance is positive, so it is 2800. Now add these two, you have the total capital, ठीक है, simple. But if the examiner is not asking you to make a separate current account, ठीक है, this is a separate current account. If the examiner is not asking you to make a separate current account and he or she is asking you to make the current account within the SOFP, you will have to do this. It is not difficult, it's very easy, ठीक है. This current account is prepared within the SOFP, ठीक है. It's the same thing. What you did in the current account, it's the same thing. You just have to list these things. One second, let me show you again. These things, ठीक है. First of all, the balance, then interest on capital, then salaries, profit shares, drawings and interest on drawings. 1, 2, 3, 4, 5, 6. So you have to include these 6 things in the SOFP and put them like this, ठीक है. You have written Mary and Jane on top, and then you will start with the opening balance, which was 40 and 600 given in the question, ठीक है. You can also look at the current account at the same time. See, these were the balances 40 and 600, so we are writing those balances. As they are positive, they will be added to their capital. They are not written in brackets here, ठीक है. Then interest on capital 400 and 350. Again, let's look at the current account. Yes, interest on capital was 400 and 350, so we are just including that here in the SOFP. Then share of profit is 1500 and 4500. Let's see, share of profit 1500 and 4500, correct, so we are including that. Mary's share was 1500, Jane's share was 4500. Salary was not given to Mary and only given to Jane, so we are just looking at the current account as well, ठीक है. Mary did not get any salary, Jane received a salary of 500, so we are doing that. And then these were their totals, 1940 and 5950. You don't have to write these totals here if you don't want to, ठीक है, this is not necessary. Let's also subtract the things which are drawings and interest on drawings. As you know, these are recorded on the debit side of the current account, so you have to subtract these out of the capital of the partners. So drawings for Mary were 2000 and for Jane were 3000. See, 2000 for Mary, 3000 for Jane, so we are subtracting that. And then interest on drawings was 100 and 150, 100 for Mary and 150 for Jane. We are also subtracting that, ठीक है. Instead of writing less, you can also just write these along with these headings and just put these amounts inside brackets to show that these are going to be subtracted. Now use your calculators, add these, subtract these from them, you will get the same balance that you got on the current account. This is minus 160 for Mary, ठीक है, the final balance, and plus 2800 for Jane. So we have done the same thing, but it's just a different format, ठीक है. Instead of making a separate current account, we have shown the working inside the SOFP here. So the examiner can ask you either to make a separate current account or to show the working within the SOFP. In method 1 over here, ठीक है, let me put this in red. This is method 1, in which you're showing just the final balance of the current account, ठीक है. The current account is prepared separately and then the final balances are put into the statement of financial position, ठीक है. But the examiner can also ask you to make the current account within the SOFP. Then you don't have to make a separate T account like this. You will not make this then, ठीक है. You will show all the working like this. Write Mary and Jane or whatever the name of the partners are in the question, and then show the working like this, ठीक है. It's the same thing. You will have to add opening balances, add interest on capital, add share of profits, add salaries to the amount given, and then subtract drawings and interest on drawings from that. and then get the final balances. Answer will be the same. Okay, as you can see, the balances are the same using both methods, because both methods are going to get you the same result. It is just a different way of doing the same thing, but it's not your choice. The important thing is, it's not your choice. You cannot decide that you want to make a current account or not. The examiner will tell you. If they ask for a current account, you will make the current account and just put the final balances here, like in method 1. Okay? If the examiner tells you to prepare the current account within the SOFP, then you will use this method number 2. Okay, so it depends on the examiner, not you. I think let's move on. Adjustments to the financial statements. Okay? All the adjustments are same as that of a sole trader business. So if you want to learn about the adjustments, please go through chapter number 15. I'm not going to repeat that because it's not needed. The adjustments are same. Okay? Accruals, prepayments, interest on bank loans, all of those are same. But you will get less adjustments in these questions because you have to work on other things. So they will not test you a lot on the adjustments. They will give you simple adjustments in a partnership question. But they're same as sole trader. So you can go through that video if you want to learn more about the adjustments. I think that's it for this chapter. If you have any questions, you can always ask in comment section. I will make things even more easier for you. Okay? I will also solve past paper questions, and then once I have solved past paper questions, I will post a link in the comment section or in the video description. So you can use that link and also look at the solved past paper question. Past paper questions will make these questions clear and easier for you to understand. Okay? That's it. Thank you very much.